If you look into the market right now, everything on a fire and US-Iran tension is rising and investors are on an edge. With all this noise, most of the people are just missed what happened in March 17th. Right now in the middle of all this chaos, SEC and CFTC just released a new framework that finally explains how crypto is regulated. But here is a key point, most of the cryptocurrencies no longer treated as a securities but as commodities instead. That means assets like Bitcoin, Ethereum and even many altcoins now falls under completely different rule sets. And this wasn't random, this was like a key drivers behind 2024 and 2025 bull run. It is a big part of what pushed Bitcoin from 40k to like 122k in at that time. So how this will impact the market? If you hold Bitcoin, you need to ask the big question here. Does your strategy actually need to change? Or in other case, if you hold Solana or Cardano or XRP or other major coins, there is a huge hidden change hitting in your portfolio right now. So what actually happened? So first, let's look at what the document actually says. There are lots of talk about the current macro situation, but if you look into the actual text, the details are really matters for your portfolio. So what this document actually? It hit the Federal Register in the 23rd March in 2026. It's not a new law from the Congress, but it is official rulebook. So this tells us exactly how these agencies are going to treat the crypto in this moment on. Both SEC and CFTC heads are signed this at the same time. SEC Chairman Paul Atkins basically said that the guessing game is really over. We are finally drawing clear lines here. And CFTC chairman backed him up by saying like this is for anyone who building on this space. And the wait for the clarity is actually finished. The wait is over. The direct quote from the government. So let's look at what actually the rules are. So let's talk about the new rulebook. The government now officially split crypto into 5 buckets. Instead of SEC claiming everything is a security, they now have a specific map right now. Digital commodities, digital collectibles, digital tools, stable coins, digital securities. For years, SEC used regulation by enforcement, meaning they didn't give any clear rules, they just sue people. So the change here is that the new document supersedes or override everything that SEC said before. So result here is that every thread or tweet or a letter sent by Gary Gensler regarding the first 3 categories like the digital commodities and digital collectibles and digital tools are now dead. The non-security assets are now outside their reach. And why this could actually fuel the rally in the future, or maybe it is very positive to the crypto environment. The thing is that investors hate uncertainty. By putting this on a writing, the US government essentially gave institutional money to a green light to buy. So they don't have to worry about SEC waking up tomorrow and calling their portfolio like unregistered security. So here is a green list. There are 16 assets that are now officially named as a digital commodities, not securities anymore. We are talking about the heavy hitters like Ethereum, Solana, Cardano, XRP, and Chainlink. But also names like Avalanche, Polkadot, Stellar, Hedera, Litecoin, Tezos, Bitcoin Cash, Aptos, and Algorand. And it's literally true that Dogecoin and Shiba Inu made the cut as well. The interesting thing here is that by putting meme coin in the same categories as Ethereum, the government is signaling that the community energy can matter just as the serious tech stock. In other words, they unified the entire market in one set of rules. And that brings us to the biggest winner of all of this, XRP. Ripple spent over 4 years and hundreds of millions for fighting SEC to prove to us in their security. But today, the entire battle just became irrelevant. XRP is now treated as a commodity, clearly defined and officially recognized and written into the system. Here is the bottom line for your portfolio. Until now, big banks and pension funds stayed away from Solana and Cardano and other cryptocurrencies because of their lawyers said, wait and see, maybe SEC called those as illegal securities. Now that excuse is dead. As of March 17th, the internal memo from the every major complaints department just changed from stay away to the green light. Now let's look into what are the structural aspects that can change after this announcement. The first point is the yield unlock. Now beyond this asset name, there are 3 specific structural changes in this document that changes the math of the US investors. The document explicitly clarifies that staking, mining, airdrops are not security transactions under this new framework. For years, major exchanges like Coinbase, Kraken has been forced to disable the staking feature for the US users because of this legal gray area. But this ruling is effectively clearing the path. If you're holding Ethereum and Solana on an exchange by earning zero, now that internal compliance just changed. Now we are looking at the massive regulatory returns of native yield in the US market. Point 2, the graduation clause. SEC and CFTC finally provided a written path for how a project moves from security to a commodity. It admits that token might start as a centralized investment contract, but as network decentralized and developers' promise are fulfilled, it can graduate into a commodity. This gives a legal roadmaps to hundreds of mid-cap projects that were stuck in the limbo. If you are kind of aggressive investor, you can watch this metric like the reclassification in Q2 of 2026 very closely. The third point is that when most of the people are not anticipating it, it's the budget gap. By moving oversight to CFTC, but enforcement also become weaker. The SEC has much larger budget, while the CFTC even operate in a tighter with a few resources, but they are still responsible for the huge market, the crypto market. What this means practical is simple. The few eyes are watching, and there should be slow response when things go wrong. And this may affect directly to the retail investors. If something breaks, like exchange fails, or maybe a manipulation happens, or a fund are lost, there should be less protection and less chance of quicker intervention. So yes, this is a green light for the institutional money to enter, but in the perspective of retails, the safety net is much more thinner right now. The takeaway here is that the regulatory win is real, but for your protection is still your own responsibility. And the self-custody will remain only your single most insurance. So let's get into much more analytical point of view. So currently we have more significant regulatory ruling in the crypto history that literally published in Federal Register. It's signed by SEC and CFTC, and it effectively supersedes years of aggressive enforcement. And yet the point is that Bitcoin is still sitting at 70k, still roughly below 40% of its peak. So the news is really strong. The real question isn't why, but why the market isn't reacting immediately. Or is there any lag in the information that actually going to priced in, or it was already priced in during the last bull market? So we will get into that one by one. At first, there should be a time delay. Big institutions like banks and pension funds just can't react to the news instantly. They need to update their internal rules and get approvals, and which takes time, usually weeks, not hours. So even though the opportunity is here, the thing is that money is not started flowing it yet. And second, there is still some uncertainty. This is an important decision, but it's not a law yet. Large investors prefer clear, permanent rules, so they may be waiting for something like the Clarity Act if just officially passed. For now, they may be seeing this as just a positive signal, not just a final confirmation. Third, the bigger macro factors are now taking over, with things like oil price surges and the geopolitical conflicts, and the market is more focused on that right now. In this kind of environment, even a very huge positive crypto news can just be ignored. The good news is real and it's already there, but the global uncertainty is having the stronger impact here. And finally, it's possible that market is already expected this. From the rise of 40k to 120k over the past 2 years may have been driven by the investors betting on this exact outcome. If that's true, the news is not going to be a beginning of new rally. Explanation has already fulfilled. So where does this leave your portfolio today? If you're holding Bitcoin, fundamentally nothing changed here, because Bitcoin was already the king of commodity right now. The ruling just put it in Federal Register with a permanent file number, that's it. Right now, most of the price movements are mostly driven by the global factors like oil prices and geopolitical tension, not crypto-specific news. Once that noise settles, now you can consider that there is a strong regulatory support in the background. So the status here is that the thesis is still going on. On other case, if you're holding assets like XRP, Solana, Cardano or Chainlink, this is a big shift. Before, there was uncertainty around whether they were securities, which kept big institutions away. But now their concern is largely over right now. This may not cause an immediate price jump because of the overall market is still uncertain, but over the next 12 to 24 months, this may open doors for things like spot ETFs, large institutional investments. The status in here is that the big monies can now enter. If you're holding assets that's not on the list, there is no need to panic here. What regulators are done is kind of creating a roadmap. If the project is really decentralized and driven by supply and demand, not a promise or something, it may still qualify in the future. So what will be your next step here will be we watch which projects are actually trying to get reclassified. That's where the future opportunity could be. So the status here is that time to research and stay alert. So the key thing is in headlines or social media hype. What really matters is the first exchange application under this framework just failed. That will be the signal that institutional money isn't just interested, it's actually entering the market. That's the moment you need to pay attention to. The SEC just made it clear that this is just a first step. The Howey test still applies, and CFTC will continue using this existing rule under this new approach. The takeaway is simple, the system is still evolving, so everyone needs to stay alert. So I think you got an understanding of what actually we have discussed. So see you then in the next video.